Welcome, everybody. My name is Lane Kaoka, and I'm going to be going over our latest offering, the Income Fund. It's a diversified pool of commercial grade investments with commercial grade tenants. And it is going to produce reoccurring income. A lot of the investments we're going to be putting into the fund are going to be, for example, land royalties and triple nets, which is going to be the basis of that reoccurring quarterly revenue for investors in here. As with any offering, want to display the disclaimer, urge all of you to read later on. For those of you who are interested, we will share the deal drive and the subscription documents, which you guys can review in its entirety. And today's webinar is meant to be a summary. If you guys are interested, of course, book a call with us and we can talk more specifically about your situation if it makes sense to invest in this investment. And additionally, please do what you guys can to not share the information provided here. We do prefer to keep things as confidential as possible due to the nature of these offerings. And I think you're going to see a bit why here in a little bit. Today's presentation is meant to be a high level of the fund prospectus. Now, we are going to be doing some live Q&A, which we will put in the conclusion of the webinar here. And then we will also have individual webinars on the individual offerings that we are going to be adding in the future. And that's the component behind this fund. It's a diversified pool of income-based types of investments backed by commercial real estate. So depending on when you're watching this webinar, the investments that we're going to be seeing on this video will already be in the fund and possibly some other investments adding to the diversification of the pool that by investing in the fund, you get instant diversification of all the assets. So starting out here, the executive summary. We'll start off our investors. A lot of times they've invested multiple times with us and they just want to see what's in it for us. Very legitimate question. And in this investment, to put it very simply, projected returns in 10 years is to more than double your capital, anywhere from 130 to 150% in those 10 years. You can see the little bit differentials between the investor classes, class C, B, A, and Z. By investing a larger amount, you're able to lower your load fees, and that allows us to be more efficient with our administrative costs and fund expenses, the legal fees to put the fund together and to fight any claims as a group. And this is going to be a big theme with this investment, which is the pooled funding and the pooled support, right? If anything should go wrong, this is why we all invest together. And additionally, I'll mention this again, we get better returns when we invest with each other than going off and being one little LP into one of the holdings that we're going to be discussing about. Minimum investments starting at $50,000. Most investors will probably be in the B class, investing about $100,000. We're looking at those, again, projected returns over that 10-year span is to more than double your money. $100,000 sample investment here on the bottom. In year one, you see the principal, which is you put down $100,000 and you can see the quarterly cash flows that are coming in each year here. We are projecting in year 6 or so, a bit of a liquidity event, says some of the investments will likely be going full cycle during that time, creating a nice little liquidity event for us. And this is money that you get to pull out of the investment to either invest in a future fund or another investment or spend it however you wish. But there will be some more equity into the fund. And then the sunset period would be that 10-year period. If you sum this first line up with the cash flow, the liquidity events, and the exit, you come up with that $135,000 projected amount. And of course, in year 6, you're seeing the principal add up to zero as you drop negative $100,000. That's your initial investment. You're getting half of it back in year 6, and then the remaining in year 10. Of course, these are general projections, and there are going to be multiple investments within this fund. But from a fund level, this is what we wanted to put out as setting expectations as projections. One component of this fund that I think is pretty unique, what I've decided to do was to make it 100% pass through to investors, meaning that 100% of what you guys invest in and get the investment returns you guys take. There's not like a 80-20 carried interest where if the fund makes $100, the general partner takes, say, 20% of that. In all investor classes, it is that 100% pass through to investors after expenses and fees. Now, next section, let's talk about what are we investing in and some of the benefits of investing with us. So first things here, real high level. It's called the income fund for a reason. It's to provide consistent cash flow for our investors through quarterly distributions. Number two, protection, right? And we're doing this several ways here. First, by investing in so many different investments and asset classes and geographic locations, we're providing investors an instant way to get that diversification upfront. We're also going to be in the role of a fund manager. So as opposed to being a smaller LP investor on your own, you've got the collective power of many and the professional representation of myself and our legal team to help you. And we're going to be going into this more and more into detail. A lot of lessons learned from my investing past. Personally, I'm behind the scenes a lot of times and I see what happens in other syndication deals. Number three here, of course, passive losses is something that our investor base is very versed in to use to offset income. Some folks out there are doing real estate professional status, a great strategy. Of course, you have to get your tax accountant on board. If you guys need a good CPA referral, please let us know. But the passive losses will be flowing down to investors in these investments. And last but not least, less risk because we're having a blend of multiple asset classes throughout the United States. So it's quite the opposite of a single asset LLC, where if something were to happen in that particular submarket or in that particular building, right? Like maybe you had a murder in that building and it kind of taints the reputation of that building. The success of our fund is not pinned just to one investment. Now, I think some investors out there, they like to pick and choose. But for most investors who are not diversified in 20, 30, 40 alternative investment private placements, to me, that's not diversification. And we'll get a lot more on that at the end of the presentation today. So what I wanted to highlight, why stick with the group as a benefit of investing as a group in our fund, just like when you buy in bulk, we're getting better deal economics. So it's my role as the fund manager to collate our investors and go to these individual operators that I have good working professional relationships with and negotiate better splits. In fact, in one of the deals that we're going to be going into as a group, normal investors investing through the operator are getting a 70-30 split and a 7-pref. What I've negotiated is an 80-20 split and a 9% preferred rate of return for our investors investing through this fund. Now, of course, this is exactly why I've mentioned, please keep this information confidential out of the professional respect for my colleagues, the operators that we're working with. This is not something that they'd preferably like to have leaked to the outside, most namely the other LP investors that they have who are getting the 70-30 split and 7-pref. Why are we getting this? We are writing a bigger check size, multiple 6-7 figures. So it makes sense on their behalf. And quite frankly, they like us and our group. They see us as a very friendly, sophisticated investor group. And in some cases, I've been able to get us into some deals where the operator is more institution. The minimum investment sizes are $200,000, $250,000. And for the average investor out there under a few $1,000,000 net worth, you may not want to plunk down a $250,000 check all by your own. Now, don't get me wrong. If you're an investor and you see a particular deal and you are willing to write a multiple 6-figure check, let us know. We can possibly make that connection for you. But in this case, what I wanted to do was to get to higher quality operators. And while I'm on that topic, this is a mistake that I made early on in my investment career where I was just investing with people I knew and people who tended to market the best. And you guys know what I'm talking about, right? People with YouTube channels, podcasts, people who are really good at social media and marketing themselves. Basically, if you guys listen to my story, call these guys the fake it till you make it. And admittedly, I was there at one time. Then we crossed over $1 billion of assets owned in 2020, and then now well over $2 billion of assets. I've gone through this personal genesis as a sponsor operator myself. And so there's a sweet spot. You want to work with an operator and go into their deals that have a track record, right? Certainly, you don't want to be investing with somebody who just joined the weekend boot camp, paid one of those investment gurus $50,000, and now branding themselves as a multifamily millionaire operator who happens to still work their IT job on the side, which is actually very common, or one of these newbie operators who will team up with 12 general partners to get a deal done. Trust me, been there, done that. I just don't want investors to go through those learning pains as I did, losing money, working with dishonest, unproven people. That said, to work with institutional operators, which I would define as $1 to $2 billion of assets owned or higher, they're going to want higher level experienced investors. They're going to be more discriminatory to who they bring in. And if you can't get in the door that way, you've got to write a bigger check. Like I said, the deal economics, better splits, and overcoming these large investor minimums, these are somewhat mutually exclusive. But I think this is the secret sauce of why you want to come in as a group with us. Additionally, we'll be pooling the reports that we get. And like I said, we have that industry knowledge and know when things are said certain ways, and we can ask the questions that I think passive investors really want to know on your guys' behalf. So these are the kind of the positives, right? These are some of the dark side of investing that I've personally gone through myself, right? When you're a new investor, passive investor, you don't know very many people. You're likely just getting the people that are really good at marketing. And you're trying to play this game where you're trying to stay away from the landmines out there, the shysters. And I've been through this, and this is why people join our family office group to get access to a community of other investors. In a way, by investing in the income fund, you're somewhat coming along the ride too without having to pay that initiation fee. But I always tell people when I first started to invest in my first 15 deals, I ran into a few people that were dishonest and incompetent. I look back and the ratio was about 1 out of 5 of the people I work with were like that. And this is something I try to help people within our inner circle community to mitigate this, which is called the counterparty risk. And inevitably, issues come up. And sometimes I was a small LP when these issues came up. Sometimes I was the general partner and had to remove general partners and take over the deal by myself. And as much as you say, trust your operator, it is very disheartening when something like this happens where, operator goes rogue, you can't find them anymore, or just give up on the deal. That said, by investing in alternative assets, you get slightly higher returns, you beat the alpha, and you get tax benefits, which you do in this fund also. And that helps you achieve financial freedom a lot quicker than doing it the traditional stocks, bonds, mutual fund ways. But you got to take on a little bit more of the risk. What I wanted to create within the income fund is this cohesive investment group where we're able to, again, like I said on the last slide, get better economics. But if things were to go wrong, we're able to use our collective power. This is where I leverage my relationships with these operational partners. But should things go south, right? This is my role as a fiduciary to you, our fund investors, to do what's necessary for the protection of the fund. And this is where I've learned this through being an operator and a passive investor. What are the steps that are necessary and the best practices when things go south, and how to initiate the legal team in the right way? Of course, hopefully we never get there. And that kind of gets us to point number 2 here. What is more than likely to happen is we don't have any of those negative types of circumstances pop up, which is what we all want. By leveraging my relationships with operators, it allows us to accommodate regional investor relation requests better, allows us to tell the story and communicate the stories to investors and what is going on in the investment. And my commitment, and I sign up as a fiduciary as the fund, is should anything happen in the event of hardships or misconduct of our operational partners, is that I will come in here and fight on investors' behalf and lead that charge. A very common situation that happens with newer operators where things start to go wrong is that the passive investors may somewhat band together and, in a way, start to take over the investment, which, on a side note, is very dangerous because at that point, they've probably crossed the line of going from a small LP investor where they have limited legal liability and they are acting in a role of a general partner. I would keep that in mind for other reasons. But in many cases, when you have 50, 100, 150 investors, it's a tall tale for one investor to break away from their jobs or their business to lead the legal battle on behalf of the entire LP base. In this case, you have me as that representative in case this were to happen. And again, I've gone through this before and I know how the best practices on how to deal with that. So for those of you guys who are part of the PTO at your kid's school and sometimes get stuck as a volunteer, whatever you want to call it, to step up and doing tasks, you don't have to worry about that should anything happen. Again, that's my role, right? This is why I'm basically getting paid to do this for you guys. Now let's talk about the economy and the real estate world in general here. What we've seen over the last couple of years is a pretty textbook correction. So for a lot of you investors who are just getting into this world now, shoot, great entry point. Here is a textbook chart of the 4 stages of a market cycle. And you can also call this in real estate, in stocks, the sine curve where it goes up and down, although it's not quite the sine curve because normally what will happen, you have this phase 1 and phase 2 of recovery and expansion. This phase is a lot longer in terms of the next phases, which is hypersupply and recession. Basically, things come down a lot quicker as it went up. And we saw this happen in 2010 to 2021. What you're seeing here is not necessarily the prices, but the cap rates. When the cap rates come down, that means the properties are worth more. And when the cap rates go up, that's when they're worth less. So what we've seen here happen in 2022, 23 is this correction where a lot of markets, it's pretty much a national thing, prices came down about 30% across the board, even if the asset is performing well and net operating income is the same. And the reason why is the Fed increased interest rates to combat inflation post pandemic and increased interest rates to 5.5%. That 5.5% was the highest interest rate hike in 40 years. And in fact, it was the quickest rate hike in history. So very much categorized as a black swan event, an event that happens once in a blue moon, but it happened. And what we're seeing here is a textbook market cycle where here the chart starts at 2012, but I would argue it probably was starting about a couple years earlier than this. And you had a nice bull run up to 2021 where you had cap rates slowly coming down, which is indicative of prices going up. And basically think like you're investing with the nice little trade wind breeze behind your back. But as the Fed raises rates, you had this dynamic where the buyers came out of the market. In fact, we didn't really buy any multifamily investments, multifamily value assets after the summer of 2022. So anecdotally, as buyers ourselves and operators ourselves, we stepped out of the market too, because deals just didn't make sense at that point. Now, what you're seeing here now this year, you're seeing the prices start to rebound. And this is again, the start of what it looks like to be a pretty good bull market. The other thing I'd like to point out on this chart is there are 4 asset classes that are listed on this chart. Now, we didn't want to put them all on here. And again, of course, this is just taking national statistics. You always want to dig into individual submarkets and more importantly, individual deals. So it's not to say that office is better than multifamily, et cetera. You really have to get down to the specific deal, which is within our fund, right? We try and select individual deals based on our standards to beat the averages of even the asset class. But you can see how some asset classes, something happens in the business and changes things. For example, multifamily, there was a lot of very aggressive lending 2021 to 2022, which created a little bit more of a hard landing. You didn't see that as much in self-storage, mobile home parks, and industrial. Office space, we all know what happened in office with the pandemic. Although, take a look at our webinar where we do discuss an office property, which is severely undervalued in terms of the pricing that we got, how we're flipping the script on the entire office trend there. Again, that'll be a separate webinar discussing that one asset that we're putting into this particular fund. And then the other one in blue is retail storefronts. And the idea here in the income fund is to diversify between several asset classes within the real estate world to get that diversification there. And not only with that, but different types of offerings in different geographic areas. People ask me all the time, which asset class is the best one? I'm not an economist. That said, I think what probably positions me better is I'm an active real estate operator in the field, putting my own skin in the game. And my colleagues and friends are in the industry in these asset classes. So I would probably argue that I may be a little bit more able to give a accurate account on what's happening in the world out there. And again, I've caveated this information is just for informational purposes and does not represent maybe a true account at the moment here. But put on here, this is the sine curve of the market cycle. And there's this component of certain asset classes in this market cycle went through a more soft landing or hard landing. People are pretty familiar with that term these days, as it appears the Fed has magically created a soft landing. And maybe everybody should applaud them or whatnot, but certain asset classes, such as hotel, office, apartments, went through more of a hard landing, and shopping centers, industrial, mobile home parks, self storage went through a more of a soft landing. And in my opinion, again, I could be wrong, but this is generally where I think that these asset classes are through in this cycle. I do own a hotel, the JFK Holiday Inn in Queens, New York. For those of you guys who fly over JFK, it's right on the peninsula there. So I'm an investor and, in fact, operator in the hotel. So I know I've been investing in industrial for quite some time now. And then office, we'll have some pictures of my past investments in office. And I think the majority of our holdings that we've operated in the past are apartments. So I think I'm more than qualified to give an account there. But this is just generally where asset classes are at this point. But a caveat saying that every market is different, every submarket is different. And then you get into each individual hotel, each individual office is very different. Investors, they think, look at apartments, it's here. At this time, we have not identified an apartment to go into the fund. But obviously, we would, if an apartment has a specific story, and the numbers work, we would put it into the fund and it would transcend this image and chart here. The reason why I'm showing this chart is to just demonstrate that nobody knows. And this is a kind of pitch to get diversification out there. And again, I think a lot of this, why invest in these particular types of asset classes in the first place? It's mine, and I think a lot of our investors' general investment thesis to invest in things that regular people use. And when regular people, the vast majority of the population, quite frankly, and the majority of those people are the lower middle class workforce type of consumer. And these are the asset classes that sort of cater to this group, as there is a growing need for that with population growth, immigration, and the general consensus that this is why a lot of us invested in little single family homes to get first started is real estate, they're not making any more of it, and it provides a basic necessity for these consumers that you would think would be very difficult to be displaced with something like artificial intelligence or whatnot. People need a place to live. So again, it's a diversified pool of different holdings, specific deals in a multiple of different geographic locations and asset classes. One of those asset classes that we're going to be going into is industrial. And we're going to have a specific webinar on these types of assets so you guys can learn more about that. But for just a real high level, we're going to be going into what a leaseback sale in industrial is. And the another asset that we're going to be putting into the fund is a land royalty deal. Yes, New York City, Manhattan. And again, we're going to have individual webinars on these specific offerings so you guys can digest this a lot better. But I wanted to just go through it a little bit so you can see the prospectus of our income fund and really demonstrate how it's more slighted to stability than maximizing returns. So first, that industrial lease that I showed, the tenant is not some lower workforce housing individual who, if something happens to them, they get sick, now they can't pay their rent. The nice thing about these industrial leases is they operate like a triple net. If you guys can Google those things, they're often seen as a very stable place to invest. Of course, the downside, and you have downsides with everything, is that you're not going to make a killing with this stuff. But this is why we've focused on this types of avenue for the industrial holdings to focus more on stability. The tenants here are commercial grade tenants, great balance sheets, complete opposite of the individual tenant that pays $900 a month rent. And they've got cash reserves. They've got a successful business. They've been professionally underwritten. And this is what provides us, the investors in this fund, with stable income and this long-term security that you have, not only this, but many other commercial tenants. Them staying in business is what we want. We want them to be successful, which they are, so that they can continue to pay their rent to us. And what this creates is a very low drama, minimal landlord responsibility situation. And I'll tell you, as somebody who used to own a lot of these like 50 unit Class C buildings, or I think one of the worst ones was 150 unit in Fort Worth, Texas. That one, we more than doubled investors' money in a few years, but we had 20% of the people never pay. We had 80% collections. And as much as money as we made, man, it was for at least for the general partners involved was a lot of headaches. And I also feel for investors. Yeah, it was nice to get that big return at the end. If you read those reports, it was a little stressful where in these types of holdings in this fund, it's going to be the complete opposite here. Now, here on the right side, again, that's the Catherine, New York deal. It's a concept of land royalties. It's a situation where you have the rights to the land and you're just the landlord and you're renting it out to, again, a commercial grade tenant, not an individual who's under $1 million net worth or under even $100,000 net worth, but a commercial grade, professionally underwritten tenant who tends to pay their rent a lot more than a individual residential tenant. This also provides in these particular holdings, there is a inflation hedge since the rents adjust in our favor over the years and creates again this minimal management, minimal headache, minimal drama type of owner's experience. Now, again, we already have about a dozen of these individual leaseback industrial assets that are going to be loaded into the fund. There's not much to look at, right? Can't really say that you're got a huge pride of ownership over this particular asset. Maybe you do a little bit more with the Catherine in Manhattan. That's actually cool to tell your friends that you own through this fund. But I just wanted to highlight this industrial investment. The key takeaway here and why it really fits our income fund is, again, those very strong financial backing of the company that does business out of this asset and how they pay their rent like clockwork, which is what we want. Now, the key thing here on the land royalty side is Why do we pick New York? New York is known as the best notoriety in terms of market stability. If you categorize markets B class, A class, Manhattan would be known as the of all real estate. So to own a land royalty in Manhattan, you just can't get any more stable than that. Now, the next deal here is an A class office in Houston called the Phoenix Tower. Now, we're going to be doing another webinar specifically on this deal. But in a nutshell, initially, before I started investing in office several years ago, I had that kind of cringe factor that maybe some investors are thinking of in terms of office, going back to work. Don't get lost in the normal headlines out there. Beneath the surface, there is running to Class A office and a abandonment of the lower end class B and C. Basically, what's happening for employers to come back to the office, and most employers do understand that you need that face to face interaction with your employees. But to do that, you need to incentivize them with nicer amenities, the A class office, which this one more than provides with you can see the pictures here. And then we'll go into more in the next webinar on this specific offering. But what's happening right now are if you have a class B or C type of office, it's going to be really hard to get your tenants back into the office there. So there's this flight from people who had offices are moving to more of these types of A class offices. And again, like from an investor standpoint, we try to zig when everybody's zagging. Right now, not a lot of people are thinking about office, right? The headlines are make it the narrative very difficult. But and this is exactly where you can pick up great deals and retrade, which this deal is actually retraded. It originally went under purchase price and then got price slashed pretty heavily after that point, which means we got a better deal. Again, these aren't the only deals in this fund, and we're going to be adding more in the future. But the last thing I want to demonstrate, the what personifies Phoenix Tower, why it fits our fund model, or why I liked it in particular, is the low amount of debt that's used to purchase this investment. In fact, the land royalties, there's no debt there. And then the leaseback sales, little to no debt. What we've seen, lesson learned from 2020 to 2023 is high amounts of debt was used, at least in multifamily apartments, sometimes higher than 75%. And when you have these natural corrections in the market, again, it goes back to old school. The amount of debt that you use, yes, it augments returns, but it also augments the possibility of a loss. And by going in with less debt, it makes it a more of a conservative play. So again, this in a nutshell, this particular offering, you're seeing the debt dialed back. And this is what accounts for the overall returns to be a little bit less than some of those asymmetric plays that I think you've seen us do in the past. If you're looking for those types of deals, they're not going to be in this fund, right? That's not the perspective of the income fund. We do individual development deals, which have a little bit more asymmetric returns. You guys can let us know if you're interested in those types of offerings, but you're not going to be finding these types of offerings into the income fund here. And like I said, more to come. And the cool thing about this fund is the more investors that we get into here, the more better collective bargaining power we get, better splits, better fees, better economics. And again, I'm gonna go back to the land royalty deal. That particular minimum investment was at least a couple $100,000. So again, if you guys would like to invest in that individual deal by yourself, let me know. Maybe you can go in it on yourself. It fits our fund perspective, but we can also write these larger checks on behalf of our collective investor base. I like to keep our group a little secret, but just sharing with a few folks here, we've got over 800 investors that have invested with us in the past. I think a lot of people, they may listen to a lot of YouTube channels, podcasts, and see these other influencers out there. We've brought in more investors and have more investors than most of those online influencers out there. And what I've discovered is, and it fits my personality for those of you guys who know me, it's better to not walk around and flaunt the numbers in most cases. What my role is to do is to use that collective bargaining power to get the best for us. as a whole. And then more importantly, get into more stable, solid deals. I think one thing where investors got hurt the last couple years was being in investments with deals that were just too big for the people involved, right? Passive investors and general partners. And in some cases, I specifically found people to work with so that we are the small guys in the bigger deal with other bigger fish. It's akin to you want to have the ugliest house in the nicer neighborhood. But specifically for investments, you want to be in a situation where if things were to go south, you look around the table and either that family office writes a $5 million check, this family office writes a $3 million check. Things are going to happen out there. And when you invest alongside those types of level investors, when things go wrong, you're able to get over those humps a lot better. And we've actually done this in the past with some of our hotel investments in New York City. We partnered with a guy, let's just call it several $100 million net worth and greater. And when things pop up, they just write a check, right? In this case, we are investing alongside not only very capitalized general partners, but other capitalized limited partners. So in a way, we're all getting a seat at the bigger kids table. And that's part of the game, right? Like you always want to be up leveling people you interact with and deals, the quality of deal operators that you're getting involved with. Like I said, this is a investment with multiple assets into it. Here's a chart on just like some of the industrial holdings that I mentioned earlier that's going to be already in the fund. And again, in that particular asset class where you're doing your due diligence, it's all based on the financial status of the business. So it's a little bit of a mind shift for some of you who own single family homes or rentals. And this is where professional underwriters are employed to do the financial underwriting of these individual business owners that in turn lease the land that we own. As I mentioned before, I think a lot of you guys know that I'm a real estate developer and operator in the multifamily investor world. Also been a passive investor. Also, I don't talk a lot about it. I've got well over 100 holdings as a passive investor. I've invested in, these are some of my passive investor holdings. This is in Houston and then Jacksonville, Florida here. But again, like all these properties I visited and walked the property with the staff. And by being an operator myself, that's at a different asset class, it's very similar, right? And this is where myself as a fund manager, I'm able to do better due diligence, ask better questions. I already understand the business plans because I do it myself. There are some nuances based on different asset classes that are just a little bit different. But this is where I've been able to professionally network and build relationships with not only the operators, but their staff and their property managers. There's things that a multifamily operator can learn from an office operator. And as somebody who I continue to be a student of the game, grow in my role as not only a fund manager and a deal operator, deal sponsor, and developer, it's allowed me to expand my network and connections and understanding of the operation of other asset classes. All right, let's meet the team that you guys are going to be involved with. For the most part, I'm playing the role of a fund manager here. We've owned over 10,000 units, over $2.1 billion of real estate. We went over that $1 billion threshold in 2020. I live in Honolulu, Hawaii, a member of various professional organizations. Most notably, I've been investing since 2009 and seen kind of market cycles up and down. As a passive investor, I've in over 100 passive investments as a passive investor, but seen it from the passive investor side of not only apartments, but RV parks, mobile homes, developments, self-storage, assisted living, and those offices and industrials that I showed earlier. I think where my experience goes beyond that of most fund operators is my professional experience as still a licensed professional engineer, although I don't plan to go back to the day job anytime soon. I used to work for Fortune 50 private company building a lot of horizontal construction there. And then for the city of Kirkland, state of Hawaii, and then the federal government. So I got all flavors of the public and private sector. This has ultimately helped me with my leadership skills with my team that I run under our house that a lot of you guys will be assisting with. But what this experience has really allowed me to do as a professional engineer, I was always on the construction management side and the owner's rep side. And that's essentially the same role I am in our 5 ground up developments. If you guys want some videos of those and what we build on the workforce housing side, let us know. We also have some other offerings there too. But this kind of is, I think, the operation role that I want to be heading down more and more in the future as multifamily value add, self storage, mobile home parks. I think it's a great place for new general partner operators to get started. The problem that I've talked with a lot of my peer operators is it's very competitive with new guys coming into the space, bidding properties up. And where we've tried to try and swim upstream and do something that's just a little bit harder that the average smart bear can't do, which is building developments ground up. What you're also seeing here in this fund is the same story, which is to swim upstream to get access to stronger operators, certainly ones that are over $1 billion of assets. And finally, my experience as an active deal sponsor, general partner of over 65 projects, I've seen things go good, go bad, and I have this insider role as an operator sponsor myself, right? When our operational partners tell us something, I know what they're saying. And in many cases, I know what they're trying not to say, if you understand that. And I think this allows our group to not only get the best terms, again, better economics, but it allows me to play the middleman in communicating the right things to investors. Quite honestly, deal operators don't want to tell passive investors certain things because it just creates much more of an investor relations cost to the firm. This is why operators bump those minimums a lot higher and they are a lot more discriminatory on who they work with as passive investors because as passive investors' net worth increase, the reason why they have so much net worth is likely they're a business owner and or they're busy or they have other investments to worry about. And the amount of investor relations friction is a lot less. And this is where we play the relationship manager between the operations and our investors, you guys. And this is part of the reason why we are getting slightly higher economics from our operators. Better splits, basically more returns than the average LP investor. If you're an investor who asks a question every other month on a monthly report, you can go invest directly with some newer operators who are more than willing to take anybody off the street, non-accredited investor also. At this point, the operators that we're going to be working with, they just don't do that. And in fact, if that is you, that type of investor, I would say please don't work with us respectively because likely like the investors investing in our fund are a little bit more higher net worth, more sophisticated, and have other investments more than likely. And but every investment, there is risk. And what I don't want to create the situation is people are investing money that they have a high propensity or a lower risk tolerance with. Again, as I mentioned earlier, should things happen, and things always do, our legal team, Dugan Kelly, I've worked with, he's probably done dozens and dozens of PPMs for me in the past, represented myself. He's also come to bat for me. He's probably forgotten, but he's gone to bat for me several times, most notably when I had that one instance when we had a dishonest operator and I had to remove him and kick him out. Dugan, I have a tremendous amount of gratitude for him, not only for his legal expertise, but his practicality in terms of business sense and working through these types of conflicts for the investors. In this case, would be the fund. Now, let's talk about some of the use cases for this investment. And this is what I love about investing and why I initially got involved in this world is personal finance. Everybody has a portfolio of investments. Some people may have more traditional investments versus alternative investments, but how do you piece together the portfolio? And a lot of these best practices have come from live events that we do, retreats, and the family office group that we have. These are some of the use cases that an investor would invest in the income fund to achieve different objectives within their portfolio. So starting here in the upper left, since it does have a nice little cash flow stream paid quarterly, you combo this with your overfunded life insurance or accredited investor banking, infinite banking, or you do the HELOC arbitrage. Some of you investors have a high amount of equity in your house because you went off of that advice of paying down your mortgage. You don't necessarily want to get a refinance right now or sell your house. So some of you guys will opt to doing a HELOC arbitrage. Not a bad way to go into the income fund, get a nice little return, and do it that way. If you haven't yet or have skimmed over the slide in our infinite banking e-course, we had a slide where, just a sample investment to demonstrate the idea where investor would fund a 6-year policy, which is pretty typical, and they would use this like, systematically from year to year, take the cash flow to pay some of the contributions for the next year. And then as the investment turns over, in this case, if you go back to the $100,000 sample investment, we're projecting somewhere in year 5 to year 7, a nice little liquidity event. That might be an opportunity for you to finish up funding your policy out of that. Again, a lot of things could happen, but I just wanted to put that into your head as a lot of you out there are master being highly strategic with these things. Of course, assuming things do change, right? And then for some of you who've been investing for quite some time and unfortunately part of the 2022, 2023 correction, great way to step up in and get any type of market appreciation uptrend or what I call the bounce off the bottom while you continue to fund the remaining years of your infinite banking policy. Next one, upper right-hand corner, the midterm liquidity. Now, this is again pointing to we are anticipating a nice little liquidity event where maybe you get about half of your initial investment back in the 5 to 7 year period. This allows you to earmark some funds where you might place otherwise. And also the income fund, since it does give you that quarterly cash flow, allows you to tune your asset risk allocation mix to the way you want. If you're somebody who's a little bit more conservative, you may want to load up more on this type of investment. And for some of you guys with kids going to college, not now, but maybe in 5 to 10 years, could be a way to combo with your college savings plan. A lot of our investors will choose not to do a 529 plan, instead, put their money into investments, which is what I do, or put it and earmark it in their infinite banking as a more superior way of than doing the 529 plan. On the bottom left here, some of you investors are what I call endgame already, 3, 4, $5 million net worth or greater, or on the sunset years of life. And at this point, all you really want is just to live off the income of your investments. And that's why we called this fund the income fund for a reason, because it's designed to optimize for security and income than maximum growth, like some of our other investments in the past. The income fund will offer passive losses. So we didn't talk too much about taxes, but the losses will flow to investors and provide tax efficiency there. Some investors may take this a step further and combo with the tax PAL fund that we have, and maybe even do real estate professional status to offset even more taxes. Interested in learning more about that, reach out. We have some other videos and that. And if you ever need a referral to a CPA that we recommend, let us know. And then lastly, there, you're going to get income, and then you have that nice liquidity event halfway through the investment. The idea is keep reading the returns that you don't spend. But maybe you're somebody who has read that book built by Bill Perkins, Die with Zero, and you've maybe not implementing to the full extent, living, maximizing life and the experiences. And part of that is spending the money, spending the income that you do have. On the bottom right, I think this is a big one that I've discovered recently, talking to a lot of newer investors. A lot of newer investors that may or may not have owned rental properties in the past, like a lot of our earlier investors, including myself. You're getting involved into the world of alternative investments and you're looking for a way to create smaller successes. And I don't necessarily want to call it out, but I will. Like a lot of people have skeptic spouses that kind of put them on a short leash. But then again, thankfully, our spouses allow us to do these types of things that are a little bit off the beaten path. But it sure would help if you would get these quarterly distributions like you would in this income fund, as opposed to having to wait 3 to 5 years for a large payoff, which is indicative of most value add type of projects or developments out there, which can be a long time to wait around. Your spouse always asking you, hey, what happened with your $100,000 investment? Did we get anything yet? Most experienced investors know that in all good things, you have to wait. That's the whole point, right? Putting the value add, putting the work in, and then cashing it out at the right time. But again, the income fund is structured a little bit differently, where it's more slighted off of income now and optimizing for security than that maximum payoff at the end. So some of you investors, you maybe started with a little bit more aggressive approach, may want to reallocate where your investments are by going into the income fund a little bit more heavily this year. So number two there, most investors will access home equity via HELOC and maybe feel uneasy about monthly interest accruing. The income fund should offset that expense while giving investor early positive feedback loop to continue moving from traditional investments to alternative investments. Now, again, like with working with so many investors over the years, more than 800 of you guys, we've probably got more than 12, 13,000 people who take a look at videos like this and the emails and listen to the podcast. But just speaking about people who have taken action in the past of investing 50, 100 grand at least, here's some of the pitfalls I've seen people step into. And starting here on the left side, what here's an observation that I've had, and I wrote this in the new book, where what I'll see most people getting started in this world, never owned a rental property in their life, they'll usually start to deploy about 10 to 20% of their net worth into alternatives in their first 3 to 5 years. And I admit this is prudent, right? Because you don't know who you're working with. It's new. You got to start somewhere. I'm all for it. If it gets people out of high fee, low return, high risk stock market, mutual funds, and off of Wall Street, I'm all for it, right? A little bit is better than none. The problem that I see with that is when you're starting out and break that down, maybe somebody's investing $150,000, $300,000 in 2 to 4 deals. That is not diversification. And that is creating a lot of exposure for yourself. My heart went out to people who just happened to get started in 2022 and they just happened to invest in, quite frankly, the worst year in the last dozen years or so. We always preach dollar cost averaging, bridging your investments, diversifying it through different years. And this sample is very typical. 2 to 4 deals is not diversified. By investing in the income fund, you get instant diversification. You guys saw how many industrial deals we have already, the office, the land royalty, and that's just the start, right? The goal is to get us in a few dozen individual investments, geographically diversified out there. The next term I want to just point out is worsification. I think Peter Lynch came up with this term. And where I want to bring it to our world, where I've seen it done, is a lot of new investors will invest in, these are called retail investors, people who don't have networks of other accredited investors, and a little bit the blind leading the blind in a certain way. They'll invest with a lot of sub $1 billion assets under ownership operators out there. And that's where I was back in 2015 and 16 when I had 11 rental properties and moving into this alternative investment world. Like I said, one out of those five operators I worked with didn't pan out. And if you can get a sense, I'm super passionate about the alternative investing world, these tax strategies, infinite banking, this trifecta to get you guys to financial freedom. And so you don't have to worry about money anymore. But part of this is like to help you guys do this is to mitigate the newbie mistakes. And part of that is stepping on the landmines of inexperienced operators and sucker deals that are out there. Worsification is investors will go out there and they're just going to invest in whoever because they need diversification. So they over diversify and they don't really spend the time to do due diligence on the people who they're working with or the deal. That said, what new investor, myself included, first starting out my first several years, had the ability and more importantly, the network to be able to do that adequately? So it's a bit of a chicken and an egg thing. The last concept that I've coined the term on is budget bound investing. Now, this is an investor's dilemma of choosing between high risk, high return investments and safer options when restricted to a spouse imposed budget limit or your own personal budget limit. So the analogy I use on this is say you go to Las Vegas. I'm not a huge gambler. I don't really like gambling myself personally. I like the restaurants and for those of you guys who came to Las Vegas with us with the retreat. The Say you were out there and your spouse gave you a budget of, you could invest, you could go gamble $100, which isn't much money these days. And you're like bummed, right? Because you probably wanted to invest more, just like how most investors are investing 10 to 20% of their net worth into these alternate investments, right? Say your spouse cut you down and you say you can only invest 100 grand. But going back to the Las Vegas casino analogy, you know what most guys will do in that circumstance is be a little frustrated, right? But go and just have fun with that money, right? Just in a way, blow it. And what are you going to play? Craps and these higher risk, higher return types of investments. Some of you guys may just put it on black on the roulette and then just walk away and then go have yourself a dinner after that. In a way, this is what I see investors do in this alternative investment world where they want to go for the asymmetric plays. Maybe that's the developments or these high value add types of deals that have riskier debt associated with it because they want to get those 20, 30% IRs that everybody kind of talks about that, which we don't project that because I think that's irresponsible. That's what people do in Las Vegas and with $100 budget. And in a way that this is what I've seen a lot of our investors do with a budget bound investing budget. And in my opinion, that's the wrong thing that you want to do with your investments, especially when you're getting started. To me, what you want to do is ease in and go in with a higher chance of returns, but not necessarily the higher returning stuff. And that's what the income fund is categorized as. Yes, it's going to require you to invest a bigger principal to get the same outcome at the end of the day. Bringing people along this journey that I have, I just want you to get going, get moving, have the highest chance of success, and get the momentum going than to strike out going for a home run right off the bat. Now, moving on over here to the other pitfall, maybe it goes out without saying, is never participating in a deal is a major mistake. I've been investing in alternative assets since 2009. And yeah, I've seen a great bull run and I've seen a big crash of 2022, 2023. I'm still here. I've learned several things along the way. As I take a step back and look at just personally being an investor in income fund myself, what got me to where I'm at? What got me to where I was 5 years ago? It wasn't going after home run plays, high value add. It was just, especially in the first several years with my first 11 rental properties, was just buy and hold, sensible real estate and consistent involvement and just dollar cost averaging throughout those years. From 2012 to 2021, there were some ups and downs in there too. But by dollar cost averaging and consistently and every time in the early years, I saved up $30,000 from my paychecks throughout the year and just putting it down on another investment. That was the slow and steady way that I did it. And what I want to arise out of all this as a takeaway for investors here. I pulled this chart again of the market cycle that we just witnessed. Right now is a great entry point. The deals like the New York Catherine Land Royalty deal, it's consistent cash flow. There is very little to no downside on that particular deal. We also get the ability to partake in the market bounce back and upside of the market just exploding from this point on. If you're getting started, this is probably one of the best times in your lifetime to get started into this type of stuff right now. But how do you do it? There's a narrative done by some other folks out there that have a little bit more of an aggressive approach than myself. And maybe I'm getting old, right? I'm getting to be 40 here. And in a way, I've got a lot of mileage on my side, just like how LeBron James and I are actually the same age. But LeBron James has played in 20 plus seasons. I've been investing in a long time myself, although I had to go to college to get a degree to make money and then save money to get into investing from 2009 to now. Some of these new operators out there and fund managers, they see this recent correction that you're seeing from 20 to 2024 as a huge buying opportunity to really go in there and dive right into the distress. And I say that's great for them, right? I think you can make great returns. I'm just not all about that life anymore. I'm more about just being consistent, getting back to the basics, dollar cost averaging. And that's why I'm personally more into this income fund side, at least at this point in my life and what we've witnessed over the last several years. And if part of this is a personal decision for everybody too. If you're under a million, 2 million net worth, you're going to have to maybe go into some more asymmetric plays developments. But certainly where I am in terms of net worth and risk tolerances, I'm more slighted on this the income fund perspective. Don't get me wrong. I think we'll do a single asset deal on a asymmetric value add play in the coming years. But I think this is where I wanted to create a safe place for people to have confidence to deploy $200,000 or $300,000 into this particular fund. Not only that, because you get better economics yourself by putting in larger amounts. We'll get into that here in a little bit. But most investors, they may put 50 grand, 100 grand into each individual deal. But you got to remember that this income fund is a diversified pool of dozens of assets. And therefore, put some thought into deploying a larger amount, 100, 200, $300,000 or greater. To recap here, the four big reasons to invest. You get the robust returns, projected 130% over 10 years. It's more than doubling your capital there. Pretty respectable rate of return, I think, for the investment perspective, low debt, stable commercial tenants, and the amount of security that you get per return. Number two, the cash flow is going to be paid quarterly, so provide income for you guys there. Number three, the protection and the blend to the multiple asset classes, multiple locations. And then sure, anything happened, myself supports the group in case of issues arising, leading the legal charge there. Number four, from a tax perspective, you're going to have the depreciation losses flow back to you guys pro rata there. And I think the kicker on this one is by investing as a group together, we get better economics, right? So you guys, for some reason, you really like a particular offering that we put in here and you want to invest in it by yourself, you want to like overweight into a certain one, let us know. We can make the connection there. But just know that we're getting likely better economics than you are as a single passive investor. And if you have problems, please don't send us an email and ask for legal support. You are not an investor in our fund. As we always joke and say at our events, we always have some kind of fun event where we take people on a bus. As the saying goes from Lilo and Stitch, Hana means family, nobody gets left behind. But jokingly, if you're late to the bus, you're on your own, buddy. So with that, the action items here, you go to the investor portal and put in your subscription. We're going to have an info page that you can get access to at thewealth.com/income. We'll host these webinars and then the future webinars of the assets that we put into this fund. You are going to be needing to do that third-party accreditation. What the best practice that most people will do is get a little form letter from their CPA or lawyer. If you guys need that form letter to make it easy for them, send our team an email. We can get you a standard copy of that so that they can just put their John Hancock on there and make it easy. We are accepting QRP money, self-directed IRA, solo 401k money. And again, here are the different classes based on how much funds you invest. By investing larger amounts, you get a slightly lower load fee in there. The load fee is how we account for our services provided in terms of the legal fees, the accounting. We have to put together your guys' tax returns and the support that we have you guys and the team. But which is what is pretty unique. What the fund makes, that gets 100% passed through to you guys. Most of these types of funds out there, there's a component of what the fund makes. Maybe the LP gets 80% and the general partner the house takes 20%. Not the case here. We wanted to attract more investors, quite frankly, so that we can negotiate better terms for myself and you guys. Again, like a lot of this is just getting back to the basics. We want to get people started on this path. I don't think you're going to get rich doing the income fund, but I think it will be a nice start for a lot of new investors. Although look at those 10-year projected returns, and they're more than doubling your capital in that time. I can't say that most people will complain about that. Now I'm going to be going into some questions that were submitted, and then we're going to be going in some live Q&A. So first question, is the income passive or ordinary gains? And this is a tax question, and we're not CPAs or tax attorneys here. If you guys need a referral, let us know, as most of our investors will change CPAs. But what we are intending to do is to have all the tax forms go on a simple K1 for you investors. Because the fund is so diversified, there will likely be multiple state returns, but which we're very aware of. And I've anticipated this. So I'm working with the operators on ways to consolidating this as much as possible for investors. It's a problem that all investors run into, but again, I'm going to try and mitigate this as much as possible for you guys. But by doing that, the real estate has losses from depreciation and business operations, and investors will get their pro rata share of those. What is the minimum investment? $50,000. What some investors will be doing is maybe adding to their position down the road. That will minimize the load fee on the new money coming in. And that kind of answers the question, can I add to my future position? Yes, you can. One component that I built into the fund was a net asset value component, or a NAV, which is very common in these types of fund of funds. What it does is minimizes the value of entering the fund later. Part of being a passive investor myself in over 100 deals, I know the games, guys. You enter the fund in late. In this particular fund, it's categorized as more of an evergreen, where we're going to continually adding more diversification deals into the fund. But what I didn't want to do is penalize the earlier investors who lean in. So the net asset value NAV component is, we're going to change the pricing of the share price, essentially, of the fund when for new investors coming in, to keep things more on a level playing field. Right. And I think all investors want this at the end of the day, which is new investors and late investors. The late investors, you obviously get your advantage is seeing what deals are in there. And that's, as we add more and more investments into the fund, check out the info page. We'll put the videos on there. Again, please don't share these videos with other people, is what we ask. But we wanted to fairly compensate the early investors, and that's why the NAV component has been built in. How often are distributions paid out? We're going to be on a quarterly schedule. Normally, it takes us about 45 days to close from the previous quarter. We've got to collect checks from multiple parties here due to the diversification of this particular fund, and then send it out. But for some of you guys who've used our portal before, it's a pretty sleek system. You get all your K1s in there securely. You have the password protected login, and then you can see all your past payments, and then you can change your direct deposit information through the portal there. So it's pretty sleek. And then, yes, you can invest using your retirement funds. And some investors choose to invest in more long-term prospectuses, such as the income fund with more retirement funds, since you're not going to be using it right away. It's more for the long-term future. So that wouldn't be a bad idea to use it for that. We are going to be doing a live webinar to pick up any questions. First question here. How much passive losses would you estimate would we receive? Is it hard to estimate since variety of assets in the fund? So trying to see if there's an estimate of some sort before investing. It is a difficult one. Normally, I have a pretty good idea in a single asset LLC where there's just one asset, on getting a cost estimate on the deductions, which, by the way, if you've heard, they may be pushing retroactively bonus depreciation back up to 80%, which this year it's down to 60. So if you were investing in years prior, or in our tax file fund, or in this particular deal, if those things do come to fruition, which I do think it will, because the Democrats want the child tax credit, you will get a higher amount of depreciation losses. But in this particular deal, I just don't want to say because there's just so many assets. And that's the whole point, right? You're getting a lot of diversification. So you're not just exposed to one particular asset. And I think this is something that a lot of investors have been asking for. You may only invest $200,000, $300,000 into these deals. Normally, you would be forced into two or three deals, and that's just not diversification. But by investing into the income fund, even a larger tranche in the income fund, 100, $200,000, you've got that checkbox on diversification right there in different industries, different geographic locations, not only particular assets. But where it makes it really hard is getting a good estimate on what the tax benefits will be. I would also say it's slightly lower too, because in this deal, we're using little to no debt. And this is another thing that I think investors have been asking for, right? Because when you introduce debt, sure, you have higher returns, you bring in the risk factor there. So I'm not going to answer that question. I will just leave it as what losses do come from the depreciation of the asset and the operations will flow pro rata to investors there. I do think, however, that it will offset a good portion of the cash flow that is coming from the investment. Next one here. Is there a maximum or minimum amount of assets in this fund will hold? What is a typical hold period for these assets? At minimum, the deals that we have in place here right now, I would probably say a couple dozen assets in here. And again, spread geographically through different industry asset classes. But I'm not going to say what the maximum is because we may not add to the fund, right? If market conditions change or we don't find deals that fit the criteria, we won't add any more assets to the fund. People read the PPM, I think it's at a 25 million maximum. That's just somewhat superfluous. That's just what's written into the docs so that we don't have to redo the docs. It's an amount where if we don't find good deals, we're not going to expand on the assets in the fund. And then the next follow-up question was, what is the typical hold period for these assets? Again, diversified, many assets. I would probably say that the range between 5 to 10 years is the typical hold lengths for these assets. And maybe even some of them will be legacy holds, meaning that we may sunset the fund in some sort of buyout situation at the end, and a minority of the assets may continue on, and we'll find a way to have investors continue on in their ownerships in some way. But that's a long time from now. And I think the important thing for now is to get the diversification, to get money working and have it diversified into different geographic areas, different asset classes. Next question. Are there assets currently in the fund? If so, when will the webinar take place to review each deal asset? So yeah, as I said earlier, there are currently going to be assets loaded into the fund as investors invest. Once we hit our designated raise that we're looking for to deploy out, we will close the fund. So these funds operate as an open close only as we have assets to deploy on. We will be releasing subsequent webinars in the future if we do add more properties to the fund. But for those of you guys who are really serious about getting in early, getting established, and then for those newer investors, a great advantage is what we've built into the fund is a NAV format here where it's a net asset value or NAV. And what that is, it associates the asset's value as they increase over the year. So we're going to increase that over the year as the assets gain more value. So what this has done is effectively leveled the playing field. Because traditionally in funds, newer investors got a little bit of advantage from older investors. And what we've tried to attempt here is to level that playing field out and to really incentivize investors in the beginning and their value of their share kind of increase over the year. It really incentivizes, I think, investors to be in early and get established as an investor in the fund. The other thing too is, right, we've seen this correction here in the past year. No time better than now, really to feel that bounce off the bottom. And those investors that get that bounce at the bottom are the ones who reap the rewards, at least what we've seen from previous corrections. But if you guys, you're interested in that, please reach out to the team. They can coordinate and get those webinars out to you. And we'll also be putting it on the income fund info page too for you guys to retrieve there too. Next question. Would there be opportunities to invest individually into one of the assets and not the entire fund? Yeah, if you're interested, some of these minimums are quite high. Like I said, some are as high like $250,000. Reach out to the team. We can connect you. But that said, make no mistake, if you're not a part of our fund, you're not getting the better terms, the better minimums. And again, if you're not a part of our fund, if anything should happen, please do not contact with me. Some of you guys were involved in some other investments out there that I have zero association with and ask what we think of the situation. We're not going to answer those questions for obviously liability questions. We just want to put it out there because there might be some kind of false association that we are your free financial planner out there, which we are not. And especially if you are not investor in our fund, you're out there on your own. And that's highlights the big reasons why to invest as part of our investment family is when you're part of our fund, we protect you and we fight as a whole and specifically legally should anything happen. And I've been through this personally and we have the legal team and I have the experience of kind of going through these types of legal proceedings to best represent you guys out there. And yeah, it happens as LPs. And I think the hardest thing for an LP in that situation is just to be a lone LP. Legal fees are very expensive. And especially if you don't know what you're doing, a lot of times those lawyers can drain you and you won't get any recovery. Next question. For the general projections, the $100,000 sample investment, why does the projected returns change from $4,000 a year to $4,500 the next year? Let me put that up on the screen just so everybody is seeing it here. Here's the $100,000 sample investment. What the question is like, why is it going incrementally up a little bit in year 2 and year 3? So what this is to account for is as you are holding on to an asset, there's obviously synergies, operational efficiencies within the asset, and this is to account for this. There is a little bit of holdback in terms of some of not the distributions on the fund side, but on the asset level in the multiple of assets where in the beginning you build up cash reserves and fortify your cash reserves. And then once you get into the investment, certainly in the year 2, 3, 4 and beyond, you tend to release that. These are just projections, right? And just like in year 6, we project a bunch of the assets to be exiting around that period. Could be a couple years before, could be a couple years after. So this is where we project that we would have some of the capital released back in that year. But again, these are just projections. It could be earlier, it could be later, it could be 20 grand in year 4, it could be 20 grand in year 8. These are just general projections. And, I would urge investors to really don't peg things on getting $50,000 in year 6, but look at it more from a longer time horizon. If you're looking for a place to store capital and get a little bit of income throughout every year paid quarterly, this would be the place to put it. And on the long-term basis, more than double your capital here in a tax efficient manner. Here's a question. What if I need to be exited before 10 years? A lot of these investments are liquid investments. However, we do have some redemption possibilities. We urge you guys to go and read that in the PPM. Obviously, in the beginning point of the fund, the first couple of years, the liquidity isn't going to be the greatest there, right? But we certainly open things up in the subsequent years to make redemptions a lot more of a possibility for investors at that point. Of course, we put the health of everybody in terms of the fund first, but we did want to create these possibilities as we do know that things do pop up for individuals. If you guys have any questions, please type it into the Q&A box. Seeing any pop in at the moment. Here's a question. Seems like this is a great way to play it safe, but what about a more aggressive play for a portion of my portfolio that also has the cash flow and equity growth like this, but quicker play? A lot of times, I think, especially in the real estate world, it's either kind of one or the other. If you want cash flow, this would probably be the place to look for it, right? Because again, it's based off of monthly cash flowing payments to the individual properties that again get that culminated for us in quarterly distributions. Whereas on the other side of the table, you have more developments or heavy value add projects where there just isn't going to be cash flow in those types of deals. Now, what we have for investors are we do developments, and I would say those would be the more aggressive plays that I would say reach out to our team if we've got any room in those types of offerings. These are more the bigger equity growth. But as far as like this offering, again, it's predicated more on cash flow and stability of the individual holdings. And part of that too is like the low amount of debt that's used in these, right? You introduce debt, you introduce more risk, and that's just not the prospectus of the income fund here. With that, I think that's all the questions we got. So we'll give you guys the rest of the hour back. Thank you all for joining tonight. The URL to go to the signing portal page will be put at thewealthelevator.com/income. And for those of you guys who are new to the signing portal, you'll have to upload your accreditation letter there. Again, the best practice that most of our investors will do is get a little signed form letter, give it to their CPA lawyer to sign real quickly. If you need one of those, please reach out to the team. We can get you that and help you out there to help expedite that. If you have any questions, please shoot us an email, let us know, jump on a call with us, can talk you through this. And then we can also share the other webinars will also be on that info page for you guys to go through too. And if you guys have any questions, please feel free to send us an email or get on the phone with us and maybe talk through your own personal situation. Thanks.